The focus of today's session is to discuss revocable trust accounts, both payable and death accounts with 5 or fewer beneficiaries, as well as complex scenarios, including calculating deposit insurance coverage for depositors who are seeking more than $1,250,000 in deposit insurance coverage. Today's presentation is divided into 3 parts. Part 1, Review of General Principles. As a quick refresher from our 2016 Fundamentals of Deposit Insurance Coverage seminar, in order to determine deposit insurance coverage, it is critical to ask and answer the following 3 questions. First, who owns the funds? Second, what ownership category is the depositor eligible to use or attempting to use? And finally, does the depositor meet the requirements of that category? The FDIC regulations provide for up to 9 different primary categories of deposit insurance coverage, and therefore this means up to 9 different ways to get separate deposit insurance coverage. For today's presentation, I will be discussing exclusively Category 3 revocable trust accounts in depth. Part 2, Revocable Trust Accounts. One of the most popular categories of deposit insurance coverage available to individuals is Category 3 revocable trust accounts. For the purpose of eligibility under Category 3 revocable trust accounts, a deposit must be a legitimate testamentary account. The term testamentary means that in establishing the account, it must be clear in the bank records that upon the death of the owner or owners of the deposit funds must be transferred to one or more named beneficiaries linked to the account. Another key point to remember is that for the purpose of FDIC deposit insurance coverage, the term revocable means that while the owner or owners of the deposit account are alive, they are reserving the right to change who will be the beneficiary or beneficiaries of the funds, and they are also reserving the right to change or revoke the amount of money that each beneficiary will receive when the owner dies. The FDIC recognizes 2 forms of revocable trust deposits, informal and formal revocable trusts. During today's presentation, I will be discussing both informal and formal revocable trusts. As a reminder, the first type of revocable trust is created in the bank records simply using language such as payable in death, in trust for, or as trustee for in the account title. The FDIC refers to these trusts as informal revocable trust deposits. The second type of revocable trust is based on a written trust agreement which is often drafted by an attorney. The FDIC refers to these trusts as formal revocable trusts. In discussing revocable trust deposit accounts, we have developed a list of 7 questions that the FDIC considers essential to ask and answer to make sure you can accurately calculate the applicable amount of FDIC insurance coverage for a revocable trust. In the next few slides, we will answer each of these 7 questions. The first question is, who are the owners of the trust account? For informal trust accounts, such as payable in death or in trust for accounts, the depositor is the owner of the account. In opening a formal revocable trust account, the owner is commonly referred to as a grantor, trustor, or settlor, and this is very important. Please don't confuse the designation of someone as a grantor, trustor, or settlor with the designation of someone as a trustee or successor trustee. The trustee designation is an administrative function, and while important in the administration of the trust, the trustee or successor trustee designation has absolutely no bearing on calculating the FDIC insurance coverage. Although the owner may also be a named trustee of the trust, the designation as a trustee or successor trustee is completely irrelevant for the purpose of determining deposit insurance. The second question is, who are the primary unique beneficiaries upon the death of the owners? At the time a bank fails to be counted or considered as a beneficiary under FDIC rules, the beneficiary must be entitled to his or her interest in the revocable trust assets upon the owner's death, and that ownership interest does not depend upon the death of another trust beneficiary. Please recognize that a contingent beneficial interest does not count. Life estate beneficiary interests, such as those that often exist for a surviving spouse, are insurable as any other eligible beneficial interest up to $250,000. Remember, for informal revocable trusts, the specific names of the beneficiaries must be identified in the bank records. For formal trusts, the beneficiaries must be identifiable from the language in the trust document. The third question is, are the primary unique beneficiaries eligible? A primary beneficiary is defined as a beneficiary that will receive some distribution when the owner dies. What we mean by a primary unique beneficiary is that although a specific beneficiary may be named on multiple accounts, the FDIC will only count a specific beneficiary once in considering the number of eligible beneficiaries. In 2008, the FDIC changed the definition of a beneficiary for revocable trust accounts. Now, a beneficiary must be an eligible beneficiary. The definition of an eligible beneficiary has been expanded to include any natural person or either a charity or nonprofit organization recognized as such by the IRS. This means that an owner can now name any living person as a beneficiary even if they are not related. And in addition, any charities or nonprofit organizations named as beneficiaries that are valid organizations under IRS rules would also be considered eligible beneficiaries. With the adoption of these rules, the former requirement of a qualifying beneficiary has been eliminated. So, under the rule, who or what is left out as a beneficiary? Specifically, the naming of any person or entity that cannot, under state law, legally receive funds under a revocable trust is invalid under the FDIC rules. For example, the naming of a deceased person, a fictional person, or a pet is invalid. There is one exception to this rule. We sometimes see revocable trusts where the owner has designated the account title payable in death to their trust. For example, a deposit titled John Smith Payable in Death to the John Smith Revocable Trust. Under the FDIC's revised rules, provided the owner is opening the trust specifically payable in death to his or her revocable trust agreement, then the FDIC will insure this deposit based on the primary beneficiaries named within the formal trust agreement. This means the FDIC will treat the account as if it were simply titled in the name of the formal trust agreement. Let's look at some examples to illustrate this point. Here on slide 12, you see some examples where depositors have opened accounts which are made payable in death to their formal trust accounts. For the FDIC to look to the underlying beneficiaries named in the trust agreement, mutuality must exist in the account title between the name owner and the payable in death designation. For example, acceptable designations would be A, payable in death to A's revocable trust, B, payable in death to B's revocable trust, and A and B, payable in death to A and B's revocable trust. In each of these three examples, the FDIC would look to the name primary beneficiaries in the trust agreement in calculating the amount of deposit insurance coverage under Category 3 revocable trust accounts. What is not recognized for pass-through deposit insurance coverage to the trust agreement is any designation where there is no mutuality between the ownership of the trust and the payable in death designation. As an example, shown on this slide, you see that A opened an account payable in death to another person's trust, such as B's trust, with the designation in the bank records, A payable in death to B's trust. The result would be an invalid designation, and the deposit insurance coverage would be based on A's Category 1 single ownership accounts, not the revocable trust category. As we know, the maximum insurable amount for Category 1 single ownership accounts is $250,000. So A's coverage would be no more than $250,000, including any other single ownership accounts A may have opened in this bank. The titling of an account B payable on death to A's trust would result in the same analysis as to B's Category 1 single ownership accounts. The fourth question is, are the primary unique beneficiaries alive at the time a bank fails? It is important to remember that the death of either an owner or a beneficiary can impact the answer to this question, and thereby the calculation of deposit insurance coverage. While there is a 6-month grace period for the death of an owner, there is no 6-month grace period for the death of a beneficiary of a revocable trust. If there is no substitute beneficiary name when a primary beneficiary dies, the amount of deposit insurance coverage may decrease for that deposit. The fifth question is, what is the dollar amount or percentage interest each owner has allocated to each primary beneficiary? If it is determined that the owner is attempting to insure funds less than or equal to $1,250,000, and there are 5 or fewer unique eligible beneficiaries, then the deposit insurance coverage is easy to calculate. We simply multiply the number of unique eligible beneficiaries times $250,000. As you can see on this chart, with one beneficiary, there would be up to $250,000. With 2 beneficiaries, $500,000, and so on. Remember that if there are 2 owners, the amount of deposit insurance coverage is applicable to each owner, and we therefore would double the amounts on this slide. Assuming the owner is attempting to insure more than $1,250,000 with 6 or more unique eligible beneficiaries with equal interest, we can simply continue to multiply the number of unique eligible beneficiaries times $250,000. If, however, the owner is attempting to insure more than $1,250,000 with 6 or more unique eligible beneficiaries with unequal beneficial interests, the FDIC will compute the deposit insurance coverage based on the greater of either the specific allocations provided for under the agreement up to $250,000 per beneficiary, or the minimum amount allowed when at least 5 unique beneficiaries are named, which is $1,250,000. I will explain this further in a few moments through some examples. The sixth question to ask is, does the owner have any other revocable trust accounts in the same bank? We must remember that in calculating deposit insurance coverage for a revocable trust, we combine the total ownership interest that each owner has in all formal and informal revocable trust accounts opened at the same bank. The seventh and final question is, are the revocable trust accounts properly titled? This is easy. The account title at the bank must indicate that the account is linked to either a formal trust agreement or is a testamentary account that is recognized as such under state law. This rule can be met by using the terms living trust, family trust, or any similar language, including simply having the word trust in the account title. For informal trust, descriptive language such as payable in death or in trust for must be in the account title. As we discussed previously, the revised rules provide that the definition of an account title now includes the electronic deposit account records of the bank. Now that we have answered these 7 critical questions, let us explore further how to calculate coverage for revocable trust accounts. As we mentioned, for revocable trust accounts, deposit insurance coverage is based on the number of beneficiaries and whether the beneficiaries are to receive equal or unequal allocations when the owner of the trust deposit dies. Let's look at the portion of the rule pertaining to 5 or fewer beneficiaries. Assume we have an individual who wants to establish a Category 3 revocable trust deposit naming 5 or fewer beneficiaries, and the total combined for all their trust deposits will be $1,250,000 or less. If the owner has named 5 or fewer beneficiaries, then the amount of deposit insurance coverage is equal to up to $250,000 times the number of beneficiaries named by the owner. But what if the owner has named 5 or fewer beneficiaries, and the percentage or dollar allocation to multiple named beneficiaries is unequal? When 5 or fewer beneficiaries are named, we will ignore the unequal allocations. Under the rule, if you have named 5 or fewer beneficiaries, then regardless of the percentage or dollar allocation to the beneficiaries, you simply multiply the number of named beneficiaries times $250,000, and that is the amount of deposit insurance coverage that will be available. Let's look at some examples to test our knowledge of the revocable trust rules. For revocable trust examples, we will assume any named person, whether it is the owner or the beneficiary, is alive, unless otherwise stated in the example. Also, we will assume the owner has no other accounts in the same bank unless specifically discussed in the example. In example 1, we have account number 1, John, payable in death, Mary, with a balance of $350,000, and account number 2, John, payable in death, Sarah, with a balance of $50,000 for a total of $400,000. Are both of John's accounts fully insured? Well, the answer is yes. Here we have one owner, John, and 2 beneficiaries, Mary and Sarah. So to calculate John's coverage, we must multiply the number of owners times the number of beneficiaries times $250,000, which gives us deposit insurance coverage of up to $500,000. So John's entire combined total of $400,000 is fully insured. Let's look at another example of payable in death deposits to test our knowledge. In example 2, we have account number 1, John, payable in death, Mary, with a balance of $350,000, and account number 2, John, payable in death to Sarah, with a balance equal to $175,000 for a combined balance of $525,000. Are both of John's accounts fully insured? The answer here is no. A portion of the funds are uninsured. Here we have one owner times 2 beneficiaries times $250,000, which equals $500,000. However, the combined balance of both deposits is $525,000, thereby resulting in $25,000 of uninsured funds. Now, we sometimes get the question, if the bank fails, will the FDIC allow the $25,000 of uninsured funds to be applied to John's Category 1 single ownership accounts if he has not maxed out his coverage of $250,000 under that account category? The answer is no. The only time the rule concerning a reversion of funds is allowed and applied is when funds are linked to ineligible beneficiaries, or in situations where a depositor has failed to meet the requirements of one of the 6 categories that apply to individuals. For the next few slides, I will discuss some of the most common misconceptions that bankers and depositors have in determining deposit insurance coverage. The first misconception is one of the most common, and it concerns the question of what is the deposit insurance coverage for a payable in death account with one owner and one beneficiary. There is a misconception that deposit insurance coverage is calculated by adding the number of owners and the number of beneficiaries on a payable in death account. To explore this issue, let's look at example number 3, where we will assume that John is opening a payable in death account, naming Lisa as the beneficiary of the deposit if he predeceases her. Assuming this is the only revocable trust account John has at the bank, what is the maximum insurable amount of deposit insurance coverage for this account? Here, in applying our formula for 5 or fewer beneficiaries, we will simply multiply the total number of owners times the total number of beneficiaries times $250,000. So, with one owner times one beneficiary times $250,000, our maximum insurable amount would be up to $250,000. This example illustrates perhaps the single biggest misunderstanding we hear again and again in calculating FDIC deposit insurance coverage for revocable trust deposits. The misunderstanding or confusion is that depositors want to allow $250,000 for John plus $250,000 for Lisa for a total of $500,000. This is not correct. Please remember, unlike Category 2 joint accounts, where every individual listed on the account is an owner and entitled to up to $250,000 in deposit insurance coverage, the rules for revocable trust accounts are different. The key point is that coverage is determined by taking the number of owners times the number of unique eligible beneficiaries times $250,000. The next misconception we will discuss concerns determining deposit insurance coverage for a payable in death account with one owner and two beneficiaries. The misconception is that deposit insurance coverage is determined by counting or adding the total number of owners and beneficiaries listed on a payable in death account. This is incorrect. Let's look at example number 4. Let's assume John is opening a payable in death account in a bank, naming his son Alan and daughter Betty as beneficiaries. Assuming this is the only revocable trust account that John has at this bank, what is the maximum insurable amount of deposit insurance coverage for this account? The answer here is $500,000, not $750,000. Again, according to our rule, with one owner and two beneficiaries, we multiply one owner times two unique eligible beneficiaries times $250,000 for a total of $500,000 in deposit insurance coverage. Again, the misunderstanding we hear in determining FDIC deposit insurance coverage is the depositor wants to allow $250,000 for John, plus $250,000 for Alan, plus $250,000 for Betty, for a total of $750,000 of coverage. This is incorrect. Let's examine another way to look at deposit insurance coverage for a payable in death account with one owner and two beneficiaries. As you can see on this slide, we have a graphic with one owner and two beneficiaries. This graphic illustrates one of the most common questions we receive from both bankers and depositors. If there are three people on a payable in death account, shouldn't the coverage be $750,000? This is incorrect. Remember, to determine deposit insurance coverage, we take the number of owners and multiply it times the number of beneficiaries and multiply it times $250,000. In this example, the calculation is one owner multiplied times two beneficiaries multiplied times $250,000, which results in $500,000 of deposit insurance coverage. Similar to slide 22, there is a misconception in calculating deposit insurance coverage for two owners and one beneficiary. The misconception is that the deposit insurance coverage is determined by providing $250,000 for each owner as well as the beneficiary on the account. This is incorrect. In example 5, let's assume a husband and wife, John and Mary, are opening a payable in death account in a bank naming their daughter Cindy as the beneficiary. What is the maximum insurable amount of deposit insurance coverage for this account? Similar to example 4, the answer here is $500,000, not $750,000. With two owners and one beneficiary, we multiply two owners times one beneficiary times $250,000 for a total of $500,000 in deposit insurance coverage. It would be incorrect to allow $250,000 for John, plus $250,000 for Mary, plus $250,000 for Cindy, for a total of $750,000. In example 6, we want to go over another area where depositors need to be careful. The issue is making sure to count a beneficiary only once in calculating the total number of beneficiaries to be used in determining coverage. Assume John opened 3 payable in death accounts, and on the first account, he named his daughter Alice as a beneficiary. On the second account, John named his daughter Betty, and again his daughter Alice as his beneficiaries. Finally, on the third account, he named his daughter Cindy, and again named Betty as his beneficiaries. Assuming these are the only revocable trust accounts that John has at this bank, what is the maximum insurable amount for these deposits? As you have seen from our previous examples, the rule for calculating deposit insurance coverage for 5 or fewer beneficiaries is to simply multiply the number of owners times the number of eligible beneficiaries times $250,000. In this example, while there are 5 beneficiaries listed, there are only 3 unique persons named on the accounts. That is Alice, Betty, and Cindy. The important point to remember is in calculating FDIC deposit insurance coverage, a named beneficiary is counted only once. The calculation here would be to take the number of owners, 1 in this case, and multiply it by 3, which is the total number of unique eligible beneficiaries. Therefore, 1 owner times 3 beneficiaries times $250,000 equals a total maximum insurable amount of $750,000. Our last example for misconceptions is based on a lot of questions the FDIC receives about the scenario presented on this slide. To start, let's assume we have a deposit account, which is payable on death account with David Smith as the owner. He has named 3 beneficiaries, Andy, Betty, and Charlie, to receive equal distributions upon his death. The account is open for $750,000, the maximum amount that can be insured. The question the owner David Smith has is, can I open a second account using my formal trust agreement for $750,000, which also names the same beneficiaries as on my payable and death account, Andy, Betty, and Charlie? And the answer is no. The key point to remember is all allocations to the same beneficiaries from the same owner must be considered in calculating deposit insurance coverage. So if an owner establishes either a formal or informal revocable trust deposit with 1 or more named beneficiaries, then the owner cannot increase or duplicate deposit insurance coverage by attempting to use another form of revocable trust deposit with the same named beneficiaries. Now let's look at our last example for revocable trust accounts with 5 or fewer beneficiaries. In example number 8, let's assume John has named 5 beneficiaries under his formal trust agreement with specific allocations to each of the beneficiaries listed here on the slide. The question he wants you to answer is, can I deposit $1,200,000 using this trust agreement and have the deposit fully insured? The answer is yes. Our rule to follow is when 5 or fewer beneficiaries are named, we simply multiply the 1 owner times 5 beneficiaries times $250,000, which gives us a maximum insurable amount of up to $1,250,000. When we add up the specific allocations, the total to be distributed when John dies is $1,200,000, and therefore the entire amount is fully insured. Remember, for 5 or fewer beneficiaries, we can ignore the unequal allocations and the fact that 3 beneficiaries are to receive distributions in excess of $250,000. We have now completed our discussion for deposit insurance coverage for revocable trust accounts with 5 or fewer beneficiaries. Next, let's look at some examples for formal revocable trust deposits with 6 or more beneficiaries. Since calculating the coverage for 6 or more beneficiaries sharing equally uses the same formula as 5 or fewer beneficiaries, we will not need to spend any additional time on those scenarios. As a reminder, for 6 or more beneficiaries with an equal share, to determine deposit insurance coverage, we use the formula of multiplying the number of owners by the number of beneficiaries and multiply it by $250,000. We will now analyze examples where the owners have named 6 or more beneficiaries with unequal interest and where they are attempting to insure more than $1,250,000. So let's begin by looking at the rule. If we assume the owner is attempting to insure more than $1,250,000 and has named 6 or more unique eligible beneficiaries under one or more revocable trust deposits, but has unequal percentages or dollar amount allocations to the beneficiaries, then no specific allocation to any beneficiary can exceed $250,000. If any beneficiary's allocation does exceed $250,000, then the default total insurable amount with no uninsured funds is a maximum deposit of $1,250,000. Since this calculation can be a bit complex, we have developed a three-step process for you to use to determine the maximum amount of deposit insurance coverage that may be available for a formal revocable trust deposit. The three steps outlined here on slide 28 should be used whenever you are attempting to determine the maximum insurable amount in situations where you have a formal revocable trust with 6 or more beneficiaries named, with unequal allocations to one or more beneficiaries, and where the depositor is attempting to insure more than $1,250,000. Let's begin with step 1. Looking at the trust agreement allocations to the beneficiaries, we begin by determining what is the largest percentage allocated to any one beneficiary. If dollar allocations are specified instead of percentages, then we simply take the largest dollar allocation and divide that by the total amount for all allocations, which will give you the largest percentage allocation. Step 2. We take the SMDIA of $250,000 and divide this amount by the percentage determined in step 1. The reason we are using $250,000 is that this amount represents the maximum insurable amount per beneficiary when 6 or more beneficiaries are named. Step 3. Look at the result. If the amount of the calculation in step 2 is less than $1,250,000, then the maximum insurable amount is exactly $1,250,000. If the result is greater than $1,250,000, then this amount represents the maximum amount that can be deposited using this trust agreement with no uninsured funds. We developed the information on the next 2 slides as a shortcut for you to use when you have 6 or more beneficiaries named with unequal allocations to one or more named beneficiaries, and the depositor is attempting to insure more than $1,250,000. The shortcut is, if in looking at all of the beneficiary allocations, you determine that one or more beneficiaries have an allocated interest at or above 20%, then we know that by dividing the SMDIA of $250,000 by the highest percentage allocation attributable to a beneficiary under the trust agreement, the calculation will always give us a result of $1,250,000 or less. So if any one beneficiary's allocated interest is above 20%, we can use this shortcut and determine that the default amount of $1,250,000 is the maximum insurable amount with no uninsured funds. If all the beneficiaries have an allocated interest at or below 20%, then we know that by dividing the SMDIA of $250,000 by the highest percentage allocation attributable to the beneficiary under the trust agreement, the result of this calculation will be an amount of deposit insurance coverage greater than $1,250,000, and your depositor can deposit this amount and be fully insured. As an example of applying this formula, you will see here on slide 30 a chart illustrating that if the highest percentage allocated to any one beneficiary is exactly 20%, then the insurable amount will be exactly $1,250,000. If the percentage is less than 20%, for example, let's use 19% as shown on our chart, then the result of dividing $250,000 by 19% will give a maximum insurable amount in excess of $1,250,000. As shown on the chart, with the highest allocation at 19%, we can insure up to $1,315,789 with no uninsured funds. Now, if the highest beneficiary allocation is above 20%, and again, looking at our chart, we will use 21%, then the results suggest only $1,190,476 as the maximum insurable amount. But the key point to remember is that, as we have repeatedly mentioned, with 6 eligible beneficiaries named by the owner, the FDIC will insure a minimum of up to $1,250,000. We will therefore default to $1,250,000 as the maximum insurable amount that can be deposited at any one institution with no uninsured funds. Okay, let's look at an example to apply our formula. In example number 9, John is the owner of a trust naming 6 beneficiaries with the specific per beneficiary allocations as listed on the slide. Assume all beneficiaries are alive and have been confirmed as primary beneficiaries. The question John is asking you is, can I open this deposit at your bank and be fully insured for the entire $1,350,000 that I have allocated under the trust agreement? The answer to the question is no. As we now know, with 6 or more named beneficiaries with unequal allocations, no beneficiary can have an allocation that exceeds $250,000. We see that Sally's allocation at $400,000 is more than the $250,000 limit per beneficiary, and therefore, using this trust agreement, John would have $150,000 of uninsured funds and $1,200,000 of insured funds. So John's next question to you would be, what is the maximum amount that I can deposit using this trust with 100% of the deposit fully insured? To answer this question, let's use our formula. Step 1. We first take the highest amount to be received by a beneficiary and convert this to a percentage. That would be Sally's allocation of $400,000, and we divide this into the total allocation for all beneficiaries combined of $1,350,000 to give us the result of 30%. Step 2. We then take the SMDIA of $250,000 and divide it by our highest percentage we determined in Step 1. This would be $250,000 divided by 30% to give us $833,333. Step 3. As we know, a depositor naming 6 or more beneficiaries is entitled to the greater of either the result from Step 2, which was $833,333, or our default amount of $1,250,000. Therefore, the maximum insurable amount with no uninsured funds in this example is $1,250,000. Again, please remember that if you have 6 or more unique eligible beneficiaries, the default amount of deposit insurance coverage is at least up to $1,250,000. Let's look at another example to apply our formula. In example 10, let's assume John is the owner of a trust naming 10 beneficiaries with the specific per beneficiary allocations as listed on the slide. Assume all beneficiaries are alive and have been confirmed as primary beneficiaries. The question John is asking you is, can I open this deposit at your bank and be fully insured for the entire $2,100,000 allocated under this trust agreement? The answer is no. In reviewing each beneficiary's specific allocation, we see that 2 of the beneficiaries, Sally and the XYZ nonprofit organization, have specific allocations that exceed $250,000. If John attempted to deposit $2,100,000 using this trust agreement, he would have $1,925,000 of this deposit insured and $175,000 of uninsured funds because of the excess of $150,000 allocated to Sally, beneficiary number 1, and the excess of $25,000 allocated to XYZ nonprofit organization, beneficiary number 5. So if John deposits $1,925,000, will 100% of the funds be fully insured? The answer is no. There is a common misconception that to eliminate the uninsured amount in this example, you can simply reduce the total deposit by $175,000. The thought is that you are reducing the two specific allocations that exceed $250,000. That is, Sally's excess of $150,000 and the excess to XYZ nonprofit organization of $25,000. This is an incorrect assumption, since in the absence of the owner rewriting his or her trust to make these adjustments, we would be reapportioning the allocations disproportionately in favor of the other 8 beneficiaries. To reduce the total deposit to an amount with no uninsured funds, we must proportionately reduce each beneficiary's dollar allocation so that no one beneficiary's interest exceeds $250,000. To do this, we must start by converting each of the 10 beneficiaries' specific dollar allocation to a percentage of the total of all allocations provided for under the trust agreement. So John's next question to you would be, what is the maximum amount that can be deposited using this trust with 100% of the deposit fully insured? Since specific dollar allocations are used in this example, we need to convert each allocation to a percentage of the total of all allocations under this specific trust, which is $2,100,000. Step 1. After we convert the specific allocations to percentages, we look to find the highest percentage allocation, which is Sally's allocation of $400,000, divided into the total allocations of $2,100,000 to give us the result of 19.05%. Step 2. We then take the SMDIA of $250,000 and divide it by our highest percentage we determined in Step 1. This would be $250,000 divided by 19.05% to give us $1,312,336. Step 3. Under the revocable trust calculation rules, a depositor naming 6 or more beneficiaries is entitled to the greater of either the result from Step 2, which was $1,312,336, or our default amount of $1,250,000. So unlike our previous example, our formula shows we can exceed the default amount, and John could deposit $1,312,336 using this trust and be fully insured. But how will these funds be allocated to the beneficiaries? As you can see on this chart, we have proportionately converted each of the beneficiaries' allocations to the amounts that retain the owner's estate planning objective, that is, the original percentage allocated to each beneficiary, with the result establishing the exact maximum dollar amount that could be deposited with John's trust having no uninsured funds. This concludes our discussion of revocable trust accounts. Remember, if you have further questions, please call the FDIC toll-free at 1-877-275-3342. Part 3, Deposit Insurance Coverage Resources. In addition to this seminar on revocable trust accounts, in 2016, the FDIC is offering 2 additional seminars, one seminar titled Fundamentals of Deposit Insurance Coverage, which will discuss the 9 most common ownership categories. The other seminar, titled Advanced Topics in Deposit Insurance Coverage, will focus on complex topics including government accounts, mortgage servicing accounts, health savings accounts, mergers, right of offset, and pass-through deposit insurance coverage. The FDIC's website, located at www.fdic.gov, is an excellent resource for bankers, as well as any depositor or other interested party who is looking for information about FDIC deposit insurance coverage. The FDIC is constantly updating this website with current deposit insurance information whenever there is a statutory or regulatory change affecting deposit insurance coverage. Among the resources most accessed is the FDIC Electronic Deposit Insurance Estimator, or EDI. This is an excellent tool to help calculate a depositor's insurance coverage based on either existing accounts in a bank or to check the amount of potential deposit insurance coverage that may be available based on a hypothetical scenario. In addition, the FDIC has written a number of deposit insurance guides available both online as well as hard copy. These include Your Insured Deposits, which is also available in a large print version. These brochures and other resources are available on FDIC's Deposit Insurance Coverage website. If you are interested in ordering deposit insurance materials, including our brochures, videos, or FDIC signage, please go to the link provided on this slide and visit the FDIC's online product catalog. These materials are all available free of charge. Finally, the most important resource is the FDIC's toll-free number. If you have any questions about deposit insurance coverage, please call the FDIC at 1-877-ASK-FDIC or 1-877-275-3342. This concludes our presentation. I want to thank you for participating.